Thank you for watching this video. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, April 16th, 2021. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the president and founder of Simple Market Signals at simplemarketsignals.com. The first chart that we're going to look at is a weekly candlestick chart of the S&P 500. It just goes back to the beginning of 2021. I really wanted to just focus on what has happened so far for this calendar year. And this week, let's start over here on the upper right-hand corner of the chart. This week, the S&P 500 was up 1.37% and closed at another new all-time weekly closing high of 4185.47, and this is the fourth weekly closing high in a row. So each of the last 4 weeks has closed at a new all-time weekly closing high for the S&P 500. The next chart that we're going to look at is a daily candlestick chart of the S&P 500 that goes back to the beginning of November of 2020. The orange line is the 200-day moving average. The green line is the 50-day moving average. The horizontal blue line here is set at 39.75, and of course we've got a trend line that I have drawn underneath a good majority of these candles starting in the latter part of March. And so let's start there. We can see that we have been on an absolute tear on the S&P 500 over the last few weeks, starting really during the second to last week of March. And you can see that the majority of the daily closes have been above this trend line. On Wednesday of this week, we did close beneath it, and then you can see on Thursday we closed right at the trend line, and today on Friday, you can see where my cursor is moving. We closed right at the trend line as well. So the bottom line is that we've had a very nice uptrend in the market for about a month now, but it looks like we might be getting a little extended here. It doesn't mean the market cannot continue to go up for a few more weeks before we see some type of a pullback, but we just need to be aware of the fact that we are getting a little bit extended here. We're over 16% above the 200-day moving average, and you can see that 200 is clear down here just right around this 3600 level, 3604.97 to be exact, is where that's setting there. And again, that represents actually a little more than 16% below where we are currently trading. And even the 50-day moving average is quite a bit below where we currently are. The 50 is going to be right around 39.50. And then this blue line here, this represents the nearest term support level. Not a lot of support, but at least some below where we are currently trading. So if over the next week or two, the market rolls over, the very first level to watch would be 39.70, and then, of course, the 50-day moving average. We might get lucky and stop there, as we have several times over the last few months. You know, right in here as well as right here, we did penetrate below the 50-day moving average for a couple of days right here. So 39.75, 39.50, that kind of represents the nearest term support level below where the S&P 500 is currently trading. The next chart that we're going to look at is a 10-year weekly candlestick chart of the S&P 500. The green line is the 10-week moving average. Of course, that's equivalent to the 50-day moving average on a daily chart. The blue line is the 40-week. Of course, that is equivalent to the 200-day moving average. The reason I wanted you to see this long-term chart is I want to just show you how often the market pulls back to the 40-week moving average or below it. So looking over here on the left-hand side of the chart, back in 2011, you can see we pulled back to and then below the 40-week moving average, and then again, pull back to it, slightly below it. And then you can get those years like 2013 and well into 14 where you do not pull back to that 40-week moving average. However, what normally happens after you go for this long stretch where you don't pull back to the 40, you then hit it numerous times and then fall below it, as we did here in late 15, early 2016. Again, we pull back to it here, pull back to it here. Again, 2017, stellar year in the market, no pullback to the 40-week moving average. However, you can see here in 2018, we pulled back for several months, ended up right around that 40-week moving average, and then dipped below it in 2018, and then bounced off it numerous times in 2019, obviously fell below it in 2020. So you can see that it's a very common occurrence most years, not every year, but most years, to pull back to that 40-week moving average. So the longer we go, right, without pulling back to that 40-week moving average, then the more likely it is, number one, that we will, right, just statistical probabilities, the longer we go, the more likely it is that we will pull back to the 40 at some point in the not too distant future. And then the other thing to keep in mind here is this steep ascent angle that we see on the 40-week moving average. Over the last 10 years, this is about as steep as we've seen, right, on the 40-week moving average. Also, the 10-week is very steep, and the ascent angle on the market itself, we've only seen that a few times over the last 10 years. So the point is, right here on this verbiage that I spelled out here so we all can see it, the steep ascent angle of the market and the moving averages, number one, shows the strong recent performance. However, remember that periods of outperformance in the stock market are often followed by, and normally followed by, periods of underperformance, retracement, and consolidation. And again, we see that, right, just by going back and looking at this period here where we went 7 quarters, basically, all of 2013 and then most of 2014 without pulling back to the 40-week moving average. And then we hit it here, and then fell below it. Same thing here. We run well above the 40-week moving average for about 6 quarters here in the latter part of 2016, all of 17, first quarter of 18, and then we pull back and ride along that 40-week moving average and then eventually fall beneath it. So periods of outperformance, like we're seeing as of late, guys, are generally followed by periods of underperformance. So I'm just pointing this out. Nobody, can forecast the future exactly, right? But we should expect at some point in the not too distant future, right, to have some type of a pullback. And as I pointed out here on the daily chart, a small pullback would at least get us down to the 39.50 to 39.75 level, which would pull us back to the 50-day moving average and perhaps slightly below the nearest term support level, which again is 39.75. And then a pullback to the 40-week or 200-day moving average would be about a 16% drop below where we are currently trading, and that would take us down to right around 3,600 on the S&P 500. Would you like the advantage of knowing when it's generally safest and most profitable to be in equities, and when it's most dangerous and generally least profitable to be in equities? Watch the balance of this video to learn more. Let me ask you a question. Do you have a stock market risk management and trend direction system in place? Do you know the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the trend of the stock market? My system is Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecast, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including numerous bull and bear markets. And what I found is that certain conditions exist during various market phases, and then I created simple, easy to understand signals around these different phases of the markets. And the thing is, guys, that most people don't know about or have access to the data necessary to do the research that I had to do to create this model. Simple Market Signals is a proprietary stock market risk management and trend direction model. And Simple Market Signals is perfect for financial professionals and individual investors. There's 2 major components to the proprietary model. There's a risk level signal and there's the general trend indicator. Let's start off with the risk signals. The risk signals are simply green, yellow, and red. The green signal has the lowest equity risk associated with it. And what you're going to find is that most all upward progress in the stock market will be made in a green signal environment. Said another way, it is hard to make money in equities unless the signal is green. The yellow signal means there's moderate equity risk, and sideways to slightly up or down price action is very common during a yellow signal environment. The red signal has the highest equity risk, and the worst sell-offs, including bear markets, will happen when the signal is red. A quick review of the risk signals. The green signal is the best risk-reward ratio signal for equity investors. And what you're going to find is that most upward progress in the stock market will happen in a green signal environment, as we see here. The red signal is the worst risk-reward ratio signal for equity investors. And what you're going to find is that the worst downturns, including the downturn in Q4 of 18 and the bear market in Q1 of 2020, plus the bear market from 2000 through 03 and the bear market of 07 through 09, all of those are going to take place in a red signal environment. Now let's put it all together and see how simple market signals could have helped you during the fastest bear market in history, which of course happened during Q1 of 2020. We had a strong stock market coming into 2020, so the risk signal was green coming into 2020 and remained green for the majority of January. We did have a yellow signal for about 2 weeks towards the latter part of January, first part of February, and then of course the risk signal went back to green. And then on February 19th, we hit what was at that time the all-time high on the S&P 500. Again, that's February 19th. And then things started to unravel from there. But think about this. Just a few days after the all-time high at that time in the S&P 500, on Monday, February 24th, the risk signal went yellow. And then on Tuesday, the 25th of February, the general trend indicator went negative. And that general trend indicator had been positive since October of 19, okay? So right there, just a few days after the all-time high in the S&P 500, the risk signals started to tell you that something was changing, that there was increasing risk in the stock market. And by Thursday, February 27th, the risk signal was red. And then, of course, the market sold off hard from there. So think about this, guys. I mean, you talk about stress testing my model. During the fastest bear market in history, that started just a few days after the all-time high at that time, the all-time high in the S&P 500, in 1 week, the risk signal went yellow, the trend indicator went negative, and then the risk signal went red, all in the same calendar week, actually within 4 days, right? Monday, Tuesday, and Thursday. So you talk about stress testing my model. Guys, I mean, this is the fastest bear market in history, and look at how simple market signals could have helped you during that time. With simple market signals, you will know what the risk level is and what the trend direction is in the overall U.S. stock market. And the proprietary model is based on S&P 500 data. The S&P 500 index really is the best proxy for the overall U.S. stock market, and it's the only index that has all of the data available that I need to run the model. And guys, it's not about beating the S&P 500. However, that is a possible outcome over time if the tools within the model are employed properly. It's about risk management and risk control. It's about controlling your risk exposure rather than letting the whims of the market dictate your future. The best fit for simple market signals is an investor or a financial professional with at least a 6 to 8 week plus time frame that they're focusing on. If you're a shorter term trader or a day trader, simple market signals may help you a little bit, but the reality is that the best fit between simple market signals and a subscriber is somebody that has at least a 6 to 8 week time frame or more that they're focusing on. These signals are delivered to subscribers in our weekly emailed newsletter. As part of the Simple Market Signals weekly newsletter, you will receive the proprietary risk level signal and charts on the overall U.S. stock market. You will also receive the general trend indicator signal and charts on the overall U.S. stock market. You will also receive a weekly recap of what happened in the U.S. stock market, including performance information and charts. And this is on multiple investments. So we cover small caps, mid caps, large caps. So you'll have a great idea of what's going on in the entire U.S. stock market across all capitalization. You will also receive technical analysis data and charts, so things that are interesting and educational that I think is important for you guys to know will be included in the newsletter on a weekly basis. You will also receive fundamental analysis data points on the S&P 500, so we look at potential earnings per share for the year, as well as the possible PE ratios, and then price levels looking out to the end of this year, and then I generally go out to the end of the next year as well. So you'll have great fundamental analysis data to work with on the S&P 500 right at your fingertips every single week. You will also receive yield curve information and data points. So we look at the 2s and the 10s. So the 2-year Treasury note, the 10-year Treasury note, and then the spread, the differential between the 2s and the 10s. This information, guys, very few people know about it. Very few people watch this. This is so important to really get your head wrapped around because it affects so many areas of the financial markets. And you will also receive the proprietary risk level signals on all 11 major sectors of the S&P 500. So not only do you get the risk level signal on the overall market, but we also give you the risk level signal on all 11 major sectors of the S&P 500. So you can see what the risk level is underneath the hood on all of the individual sectors. And you will also receive sector performance information on all 11 major sectors of the S&P 500 over multiple time frames. So guys, you're going to get all of this, right? And it's going to make you so much more knowledgeable about the financial markets. You're going to be able to have a conversation with virtually anybody about the stock market, and you're going to be able to really understand things at a level that very few people do. And guys, you're going to get all of this for just $19.95 per month. That's less than 67 cents per day. I want to set realistic expectations. The weekly emailed newsletter isn't fancy. It's effective. It's plain text, no color, other than the charts, of course, and no fluff. But it's chock full of extremely valuable information week after week. And please note, due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, this is just due to international compliance regulations. A subscription to Simple Market Signals is just $19.95 per month. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. Sign up is quick and easy. Just go to simplemarketsignals.com. That's https://simplemarketsignals.com. It'll take you about 4 or 5 minutes to subscribe. It's that easy. Once you reach the website, the first thing you will need to do is accept the cookies. Please notice that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to use this website or our services. And that is just due to international compliance regulations. All right, so to get started, all you have to do is click this green button, and that will take you to the product page. And this explains, of course, what you get with your subscription. And then just make sure that that says 1, because if there's more than 1 in there, if you have a 2 or a 3, you'll get multiple subscriptions to the service, and you only need 1. Click the Sign Up Now button, and that will take you to the checkout page. Once you're on the checkout page, fill in the necessary information, anything that is required, including the email address. Keep in mind that this is an email newsletter, so we will have to have your best email address on file, and make sure this box is checked, because that's how your email address gets into the system. So if that is unchecked, your email won't get transferred into the Simple Market Signals system, and you won't get your newsletters. So please make sure that box is checked. And then, of course, just double check, make sure that your monthly total is going to be $19.95 a month. Remember that your first 2 weeks are free, so your first renewal date will be 2 weeks after your subscription date. Fill in your credit card information. You will need to accept the privacy policy and check that box that says you've read and agreed to the terms and conditions. Click the sign up now button, and it's that easy, guys. It's probably going to take you maybe 4 or 5 minutes total to fill in everything and subscribe to Simple Market Signals. A few points to remember with respect to your subscription to Simple Market Signals. Remember that everything is tied to your email on file. Now, once you subscribe, you will get an immediate emailed confirmation of your subscription. You will also receive an automatic welcome letter, so that's automatically generated from our system. And whether you see that welcome letter or not, I would encourage you to double check your spam, junk, trash, and promotion folders, especially for the first several weeks of subscription, because once in a while, our emails get automatically routed into one of those different folders depending on your email service provider, whether it's Gmail, Yahoo, whatever it may be. And I would get in the habit, I would encourage you to get in the habit of every week or two, just go out real quick and double check these different folders, the spam, junk, trash, and promotion folders, because I can't even tell you how many times I've had people say, well, I didn't get the email, and then when I tell them to go out and check those various folders, oh, there it is. So it's just, the reality of having an emailed service that once in a while, and it's going to vary from email service provider to email service provider, but once in a while, the emails from us, depending on the subject line and other things, will get automatically routed into one of those different folders. Also, I would encourage you to whitelist all emails from Simple Market Signals. In other words, just make sure that your email service knows that you want all Simple Market Signals emails to go to your primary in basket. Also remember that newsletters go out on the weekend, okay? They generally go out Saturday afternoons, but they could go out anytime over the weekend depending on our production schedule, and the next new edition will be sent to you on the weekend following your subscription. So if you subscribe on a Monday, Tuesday, Wednesday, whatever it is, the next new edition is going to come out on that weekend following your subscription. But we will also send you the latest edition, so whatever the most recent edition of our newsletter was, we'll send you that latest edition as soon as we can, but we have to manually send that to you. Generally, you will receive that within 24 to 48 hours of your subscription. So again, if you don't see that first newsletter within 24 to 48 hours, go back and double check your spam, junk, trash, and promotion folders to make sure that it's not hidden in there. Also, within that first 24 to 48 hours, we're going to send you at least 1 or 2 emails with links to training videos that are for subscribers only. So please make sure that you're looking at all of this, because it's extremely important for you to get the most out of your subscription. Please watch those videos that are part of the training material that we send you. Now let's recap what you will get with your Simple Market Signals subscription. With your subscription, you will receive the weekly emailed newsletter, which goes out on the weekends, that will include all of the content that we just talked about. Plus, you will receive midweek update emails when warranted. So if there's a major signal or trend direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to send a midweek update email to get you that information as soon as possible. So again, a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents a day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. To get started, just go to https://simplemarketsignals.com.